Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch, and Ben, welcome back to you.
Hey, mate, how are you?
I'm very good, thank you.
Good.
Been up to much? I can tell you what you've been up to.
What have I been up to?
RBA announcement.
Yeah, did that this week.
Yeah.
Did you pick up the error that I made?
Not yet.
Have you listened to it?
Yes, I have.
At the end, I talk about that the federal government is going to do cuts, rate cuts, not tax rate cuts.
Oh, yes.
So it'll be tax rate cuts.
How do you feel about misleading the people?
Well, no, it's still a cut. I just, if I was listening to it, because I thought, wait a minute, did I say that the right way? And I had a quick listen and I went,
Oh, did you listen back to it?
I did listen back to it.
You won't listen back to our podcast, but
That's
you listen
not
back to your
true.
little solo announcement. Is it just me? Is it something I said?
I get the one down low, Bryce. I play it, I just play it low.
Very good, well done. So the cash rate stayed on hold.
Yes.
You got to pick a webinar coming up.
Yeah, we do. So Bradley Beer, who's a quantity surveyor, who's an expert in tax depreciation, is going to do a webinar in conjunction with a special guest to be announced, who's also going to deep dive into lending. So it's basically a 1 hour webinar that we're going to do, on the 19th of November, which is a Tuesday, the 19th of November. It's going to start at 7 p.m. Details in the show notes. So 20 minutes on tax depreciation in terms of what's now available to you. Obviously changed a couple of years ago. And then 20 minutes in terms of how you prepare and get yourself organised before you put your lending application in this new age of lending. So that one's going to be quite interesting. And then 20 minutes of Q&A. So a nice little wrap. So obviously,
Mate, just keep delivering the gold over there,
well,
Picker.
That's it. You need to be a Picker member, all $5.
Yep.
$5 or $20 for 5 years.
Yeah, it's expensive.
So yes, we're sort of getting close to that 3,000 members. So thank you
well
to
done.
all of
That's
those people who are basically joining for educational purposes and also for advocacy. So that's the news at Picker at the moment.
All right, love it, mate. So and just a reminder that we have the makemoneysimpleagain.com.au book giveaway.
Grab your book, the best instruction manual to attract more surplus and put it to work.
Yeah, it's free, folks. It's free. It's a freebie.
It's a best-selling book.
If you haven't got it,
we've made free.
If you haven't got it, it's for free. All you need to do is go to makemoneysimpleagain.com.au. But here's the catch, Ben. There's always a catch.
Always a catch. What's our catch,
Bryce? The catch is very simple, Ben. We're not going to leave it up there forever. We're going to pull it down.
Good catch.
So go and download it, folks. Hey, I got this. I want to read out this review, Ben.
Sure.
Now, I listen to a lot of podcasts, as do you, right?
Yes.
And they always read out the 5-star reviews, right?
Yeah.
I'm not going to read out the 5-star review. I'm going to read out the 3-star review.
Got a 3-star?
Yeah.
Okay, middle of the road. Okay.
And you're
Hit me with it.
You're in the gun. You ready?
Oh, it's me?
Yeah.
Oh, God, what have I done wrong?
Well, if it's me in the gun, I probably would have gone into self-preservation
You
mode.
wouldn't have read it, would you?
But I'm not going to announce the person's name because I haven't sort of got permission.
Yeah, no, fair
it's put it
enough.
on a public forum, but...
Yeah, well, you can find the review amongst the 1,500 that are in there.
You'll notice why once you hear the review, but here it goes.
Here we go.
TPC Squad. Love the work, love the podcast and the chats. However, one criticism.
Oh, okay.
But before he gets to the criticism, gives a backstory. Okay. So, I'm 32 years old, own 3 properties and use Money Smarts. 42% LVR on 1.65 million assets. So all looking pretty good so far.
Nice.
I've managed to get the great woman, in brackets, my girlfriend, to start listening recently.
Oh.
Thank you. Appreciate that.
Good. That's all right.
She's budgeting,
Sorry
she's
about
categorising, spending, not blowing cash anymore, and loves that you 3 aren't white shoe spivs from the Gold Coast.
All right.
White
Shoe Brigade from the Goldie.
Yeah.
Okay.
That's a compliment because I used to live on the Gold Coast.
Yeah.
All's going well! Exclamation mark. So I don't see why we get a 3 stars
so far.
All right.
What have I done wrong?
It's in small print, so you gotta. I've put it on my phone here, and I can't blow it up. Right. So I just realised. All right. We started to listen to the podcast every Friday night when heading to Newcastle, New South Wales for the weekend, or the return leg to Sydney on Sunday night. Smart move by me, I know, captive audience. It goes swimmingly all until Ben.
Right.
In brackets, love your work with the last election and economic breakdowns, by the way. Ben starts on about global warming or Donald Trump. Then I lose her for the rest of the 1 hour journey about Orange Man and so forth. So, please, can you do me one favour? Please drop off the global warming comments and hanging it on Trump until the end of the podcast, i.e. the last 1 or 2 minutes or 5 minutes. Gives me enough time to park the car and ask what I'll make for dinner. See, the issue is my girlfriend is a bit of a raging lefty, and when Ben starts on about old mate in the White House or global warming, I lose her the entire trip and the ability to plant the seed as well as part of the weekend. Please, guys, as a favour, I'll endeavour to repay. Help me keep our collective head in the game with this. Love the work, big fan. Only put a 3-star as I thought you'd read this comment this way. I'm not sure if you would with a 4 or 5 review. Happy to change the rating later. Thanks, and then signed off by the person. Now
we do read all reviews.
We do read them all, even if they're 5s, just for the avoidance of doubt, we'll read those. But how do you feel about that?
I don't know who it is, but thank you for that critique, because in my rates announcement on Tuesday, I talked about nuclear energy.
Didn't talk about Orange Man though.
But I took his advice, right?
You didn't talk about President Twitter?
I did it right at the
end. Without even knowing that?
Without even knowing.
All right. So there you go to that. We'll keep them anonymous for
funny.
now. That's good.
No, but yeah, I'm in my limited reading on nuclear, I think it's a no-brainer.
Yeah,
in terms of global warming.
You like to be you like to talk about a lot of things, Ben, and have an opinion on a lot of things.
Oh,
so
no,
that's like cutting out that's like asking to cut off your left limb, really, isn't it? So, all right, there we go, folks.
Thank you for that feedback.
It was super.
The critique.
The 3-star. So there you go, folks. We read out all reviews. Well, actually, I don't read out them all.
No, not all reviews, but that was well crafted. It was a good, fun review.
Yeah.
And when it's always at me, I'm very happy to have it laugh at myself.
Yeah, well, you're always allowed to return serve if you want to trawl through.
I give it as good as I receive it. That's right.
But mate, because there's a million things I reckon people could write in about me. Stop saying all the time. I try and stop saying folks. I'm so sorry, but I can't stop saying it.
Just on that point, when we were recording my rate, she goes, I said, how'd that go? She goes, a lot of ums. You were you tuning Bryce?
Did she say channeling me?
Channeling Bryce.
Not happy. Lucky you can't write a reply. Okay, my mindset minute today is talking about skepticism. I've yet to meet a person who was skeptical. I was researching some online stuff, right?
Okay,
so unrelated to our topic, but I'm always trying to find out better ways on how I can deliver better content.
Yeah.
The three of us, collectively the three of us, can deliver better content, right? So I've yet to meet a person who was skeptical about any topic ever, who then goes on and be successful with that thing. For example, Ben, those who are skeptical about a diet never have success with the diet. It becomes a self-fulfilling prophecy. Yeah. So here's my suggestion. You need maybe to change it to what if? What if it worked? What if it was true? What does that mean? What does that open up? What are the possibilities if that is true? Now, what I'm not saying is have blind faith.
No.
But don't close the door without having a bit of a look. Yeah. So those who walk in faith and belief in the system are the ones that somehow always find success, Ben. So if you think about the people that we've spoken to, who write into us, who actually give us feedback on the podcast, it's usually because they believed they were coachable, Ben. They actually said, well, I'm going to put aside my ego. I'm going to put aside all of my my held beliefs, and I'm going to say, maybe Ben and Bryce, who've done this for 20 years, maybe they might have accumulated some wisdom that we can take on board. And therefore, if we follow their system, where we trap some surplus, and then we're at a decision point in the road, we can either trap the surplus and spend it on lifestyle, which is fine if you want to live for the here and now, or you could trap the surplus and spend it on a little bit for tomorrow, which is our preferred method. So it's a very simple system for those who walk in faith. Now, in fairness to folk, Ben, our industry has way too many get-rich-quick schemes, wild claims, and let's be honest, a load of stuff will cross people's desks that just seems way too good to be true.
Correct.
So having healthy cautiousness.
Yep. Healthy scepticism.
Yeah. Well, I don't want you to have scepticism because I think it's a roadblock, but have some caution. Because scepticism just becomes a self-fulfilling prophecy. See, I'm looking for all the things that it won't work.
Yeah.
Whereas if I'm cautious, say, okay, like I said before, what if it worked? What if it was true? What does that mean?
I understand what you're saying. That's the language.
So what I'm saying is, don't be ignorant, but don't be sceptical. Is the suggestion today, because it's pretty simple. Number 1, plan. Number 2, trap your surplus. Number 3, invest your surplus. Number 4, create financial transformation. It's a pretty simple system.
Very good.
There you go.
Well, it's a nice little segue into our discussions today. A bit of Q&A coming through, and it's on the back of some feedback that we've been getting from some of our staff, as well as some of our listeners who have been listening to a podcast from the ABC called Money. The Money. And there was a great podcast on there recently around the financial risks of unregulated property investing, right? So we've been on about this, and as you know, as the former chair of the Property Investment Professionals of Australia, I have sat in front of a Senate inquiry debating the pros of having property investment regulated for direct residential property. So I'm very familiar with this topic. Our podcast is very, very familiar with this topic, and it's a great 30-minute podcast. So we're going to put the link in our show notes because we think it's important for everyone to listen to it from from our point of view. We are biased towards residential property. We're very, very clear on that. We think residential property is a pathway to create financial peace. We are disclosing that up front, but we think that there are ways in which some operators are doing it, which is somewhat challenging in terms of self-interest as opposed to the best interest duty on getting the return for the client as opposed to your financial return as someone in this space.
So quick backstory, Ben. I recently fell into the trap, you may relate to this, where I was talking to someone and I made an assumption that everyone listens to the first 20 episodes of our podcast. Now, in chatting to the person, they said, love the podcast. I said, the first question I always ask is, how many have you listened to? Just so I can gauge. They go, I'll probably listen to the last 15 or so. And so if anyone's joined our community and is listening to this and they haven't heard the first 20 episodes.
Yeah, we were pretty horrible. Like we had no clue what we were doing. We were just riffing it.
But the content is really, really important.
And it's evergreen.
The delivery was pretty rubbish, but it's really, really important.
I don't think we've improved much, to be honest. Iris is nodding. She's confirming that they haven't really improved much.
So the point in saying that is the assumption that I make that everyone knows the first 20 episodes is wrong. And I also know that I've joined many podcasts where people, like we're up to episode 257, someone can say, really? You want me to start at episode 1? The answer is we do, and we want you to stop about episode 20, and then if you want to work your way through the most current ones, but those first 20 are really helpful. But the point in saying that is, the reason we're going to talk about this today is because some people haven't heard our message around what we're going to talk about.
Yeah, with off the plan and house and land packages,
So to set the scene here, there is a
selling agent.
Yes.
But they operate, and this is how basically the business model for most property investment businesses is to organise an audience, educate them around the benefits of property investing, but effectively they receive a commission or a marketing fee or a kickback from the builder or developer. So in reality, they spend a bit of time in getting people excited about the potential of property investing, as do we when it's done sensibly, and they receive a commission, referral fee, whatever it is, but they are registered selling agents, but it's almost they're under the guise of a buyer's agent, right? Because or an advisor, and that's where it's this big grey area, and we think that could be cleaned up. And then when we, basically when I listened to the podcast, when one of my guys here said, look, check this one out, it talks very similar to what we've been talking about.
Talks about a couple of people got burnt in financial distress.
Really,
and
difficult stories.
Folks, that is the whole reason that we did this podcast, is because those stories hurt when we hear people tell about them. They go backwards, and then to recover from going backwards is not only have they gone backwards, they've then got to spend the next decade trying to even come back to break even. Because as you'll hear if you go and listen to it, there's a guy who's just hoping at some stage in the future that returns back to ground zero. Which is terrible. So we'll put a link in that. But I wanted to use that as an opportunity to talk about my past life, Ben. Because for those people who don't know my story, I saw Jan Summers, who was my initial virtual mentor, on the Ray Martin show. She was up there with a whiteboard saying, tenant and taxman pays most, if not all, the bills. I was at uni at the time. I was meant to be studying. I was at home watching television. And I just looked at it and I remember thinking, wow, like, why isn't everyone doing this? I was young, I was naive, I didn't realise about mindset and all that sort of stuff that people got to overcome. But the mechanics of investing in property was so straightforward, as she described. I was just thinking, why doesn't everyone do it? I then was on a mission to find out as much as I could, and I stumbled across a group that was a club. And that club was teaching people how to invest. Now, you've got to think, this is back in 1998. There wasn't as many books on the marketplace. There was no podcast. There was no online webinars. There was
no search portal, mate.
I'm one of those guys who got a university degree, BG, before Google. So I didn't even use the internet before I graduated. So there was none of that stuff. And so I went to this group. And I've said it before, I was an enthusiastic amateur. I wholeheartedly, I'd bought in, but what it was we were helping people buy a brand new off-the-plan product. Now, thankfully, as I look back, Ben, most of it was townhouses. So there was a land component to it, and I feel quite peaceful about that, but there was some off-the-plan apartments. I've never been involved in a medium or a high-rise. I have been involved in low-rise apartments, and I can hand on heart at the time say that I thought in my mind that I was not deceiving anyone. I thought I was doing the right thing, right? And at the moment I realised I wasn't, was in 2005, and then I moved to established in 2006, and I never got involved in brand new ever again, with very few exceptions when someone specifically said that and has acted against my advice. So what used to happen is we used to get a contract, and we used to make it subject to finance. And what would happen is the bank would go out and they'd do a valuation. And the valuers are no fools. Like, they'd see these developments all the time. And they'd effectively rebate. So let's say the price of the property was $220. The valuation would routinely come in at $205. Because the marketing fees at the time were $15,000, right? So they knew that. So what would then happen is you'd have a conversation with the client and say, and again, there was no deception here. It was actually, I genuinely thought that the valuers were out to get us. That you would then have to say, that's okay, because you can use equity in your home to actually cover that. So you can still borrow the whole amount. You can still borrow the 106% that you need. Subject to finance, the bank would say, yep, we'll do it subject to an on-completion valuation. So essentially what you were doing is you were running the gauntlet, because you were actually saying, all right, it's subject to finance. I've actually got to say yes or no to this condition, and the bank has actually said, well, we'll give you a conditional approval subject to an on-completion valuation. So you're only 90% over the line. And so at the time, the clients were running the gauntlet, because they'd go, yep, satisfy that condition. They'd pay the deposit, which was typically $1,000 once the contract was signed, and then balance of $20,000 when it went unconditional. So they'd stump up and then they were in bed, and then waiting for the product to be built. And luckily, during the time when I was involved in that, it was in the early 2000s where a lot of stuff was rising. So the clients actually did quite well, right? No, actually, I'll rephrase that. They didn't go backwards.
It wasn't negative equity.
It was marginally in front, probably just covering stamp duty.
Well, some people like to speculate, thinking that values are always when they're running. That's when they buy, right? And they think, well, hey, if it keeps going like it is, I've paid $500,000 for this property, and by the time it finishes, it's going to be worth $530. So I'm making money with nothing. But obviously
because what happens is people were majoring in the wealth creation paradigm. Buy an investment property, get the tenant, the taxman paying most of all, buy multiple properties. At that time, I was in Perth, people were buying interstate, so all those sorts of concepts were fine. But no one was having dialogue around what we hope the void that we filled on this podcast is location is 80% of the heavy lifting. What assets should you be buying? What assets should you be avoiding?
Investment grade versus investment stock.
Absolutely, Ben. So that was the thing, right? So the reason we were enthusiastic amateurs, and a lot of us were at the time, is because we wanted financial transformation. We wanted the best. I was investing in these properties myself.
Yep.
I was walking the talk. I was like Rick last week when we talked to Rick Hockey up in the Pilbara.
Yep.
I was the same. I was investing in the stuff that I was encouraging. Yeah, you bet I was. So it wasn't like I was just getting. Well, I did get healthy sales commissions, but what I remember, and I wanted to tell this story. I remember there was a house and land package, and I was. Back then, the Queensland government introduced the Property and Motor Dealers Agents Act, and so they changed it and they had this form which was called the Form 27B. And that 27B was a disclosure statement to say how much are you actually getting paid. And I remember at the time it was a lot of there was a lot of hullabaloo around that, right? But
because no one wanted to disclose.
Well, no one wanted to disclose.
Because, like, you know,
But what the builders were doing is saying, well, you only have to disclose on the settlement of the land. You don't have to disclose on the building contract, right? So
so they were trying to get around it, right?
They were trying to get around it.
Now, that's a signal in itself in terms of best interest test, isn't it? Like, I don't want them to know that I'm earning $15,000 in commission, because if you don't, so that's either a test of value in terms of have you added that value or not added that value. Whereas if it's hidden or built into the cost of the
So if the clients, so what happened is within our business we had a client who wanted to buy a house, didn't want a townhouse, didn't want an apartment. Fair enough. So I went and approached the builder, and he said, "Sure, no problem." And I said, "I want that piece of land. We want to put that house on it." And he goes, "Sure, no problem. Send me an invoice for $25,000." I went, $25,000? He goes, "Yeah, that's how much we'll pay you for putting." And I must admit, at that point,
and it's a long time. You know, that's many moons ago, right?
We're talking 2003,
early 2000s,
maybe 2004.
Yeah. It's a lot of money.
When the commissions at the time were about 15,000. And I just remember thinking, oh, that just doesn't seem comfortable. So I never got involved in the house and land. Now, the irony of that is that it probably would have been better for people to be having the land holding.
House and land holding versus the townhouse.
At the time.
But
I just thought to myself, $25,000, Ben. Like, it just didn't seem right.
So can I ask a couple of questions? The first one is around, because things have changed, and that's what I want to document in terms of, there's a particular person on the podcast talking about the system protects the client. They were his exact words. The system protects the client. Now, I'm going to come after that because I don't believe that to be true.
No, it's not true.
But so when
at a very small, at a very distant technical level, he's right. But it's so faint because the system doesn't protect the client. The trigger can potentially protect the client if.
And there's a lot of ifs.
They know what they're looking for.
Correct, because what you're saying is in your day when you were doing it, you would do a subject to finance on, now, so let's go through the process. I've signed up with you, I've got a subject to finance, and I've bought that property, let's call it a townhouse for $225, by way of example.
Back in those days, it was like 170 and 180. And
180, right? And so we've got the 180. I'm now going to the bank because it's coming close to completion. And the bank comes in and says it's worth 165, but I've paid 175. So you then get that information, and or the client rings you and says, it's come under value.
I didn't experience anything that didn't value up at the valuation that the at the beginning. So it was never subject to val. Let's say it was 180. And it came in at 165, for example, and the client said yes at 165. I never got to the point where, when it actually titles were issued and it settled, that 165 became 125. I was never in a mining town. I was never in any of those sort of scenarios, right? So I've never experienced any of that world of hurt. I'm not like I'm saying that's a part of my professional.
But you were aware of it in terms of, because what would normally happen is, going back to what you were saying a minute ago. If the valuation did come in short, the operation of that sales agent is to then call the customer and say, hey, here's and whatever the value. I don't think they've got it right, but you can still get it approved because you can use the equity in your existing home. But there's some people who didn't have equity in their existing home.
Well, then they couldn't have proceeded at the finance level. But here's the collective, enthusiastic, amateur contagion, right?
Yep.
What's a better word? But we all thought at the time, like if someone at that point, if they knew better and then they were encouraging the client, that's deceptive and not acceptable, right?
Yeah.
I was in my early 20s and I genuinely thought that the industry was just
making it difficult. The valuers were just making it difficult. You needed to.
I look back now and I even struggle to get
the valuers aren't earning half of what you're earning. No. They're just making it difficult.
I just even struggle to get those words out of my mouth now because I'm embarrassed about that part. But at the time, there was no deception.
But that's why you're sharing your story now, Bryce.
That's why I'm sharing the story now, because I don't want please hear this story and don't let it happen to you.
So as part
because then what would happen is, to finish your question.
Sure.
Is you'd ring the client and say, all right, the valuer, don't know what they're doing, it's that valuer again, it's come under 10 grand. Because we're only talking 10 or 15 grand, it's not 50 or 100 or anything for it, was 10, 15.
Yep.
So therefore, collectively, with the equity release you've got in the home, you can still cover the full purchase price, so the developer's getting their money, and we would get paid, Ben, half of the money at unconditional and half once the titles were issued and it's settled. So,
right. So Michael, the journalist from the ABC, is interviewing this particular promoter because that's he's a sales agent. He explains the business that he's involved in, and then they ask a good question in terms of how are you working in the best interest of the client. Now, a couple of things come up. First of all, he's saying, well, I've got choice of a lot of stock. So in other words, I've got house and land package, I've got apartments and so forth, and we work with some of the biggest developers. Now, my first view on that is, okay, you've got a small choice of the market, because new stock in the property market represents about 2% of your total choice of the market. So you're saying basically I've got a choice inside that 2% to basically look after the market, and very proud of that is I think the wording he used. But then it goes on to sort of say, the question is next, how is that working in the best interest of the client? Well, the client is informed throughout the whole process. Now, this is where I know that the information that's being presented, or the wording that was then used, was the system protects the client. Now, here's the challenge with that. And what was failed to be informed of the listener is the fact that if I've paid a deposit, Bryce, and in some cases my deposit is 5 or 10%. So if I'm buying an off-the-plan property or a house and land property for $500,000, I've injected $50,000. Now, what basically they're saying is, once the valuer comes back, and if the valuer comes back and says, sorry, that apartment's now worth $450,000, he's saying that the system protects the client. How's that protecting the client? I've signed a contract of sale and I've put $50,000 deposit down. My deposit is at risk. If I don't proceed with a property that's now in negative equity, how is that in the best interest, and how is that protecting the customer? Because my understanding of the way in which these property sellers work and the property marketeers work is that they have to get a deposit on that property. They absolutely have to get a deposit. Now, they'll need to get more than $1,000, by the way. And usually, if you read the full contract,
absolutely they do. Because I had relationships with developers that allowed the trust of what we were doing. But you're right; that makes most of them uncomfortable if there's only $1,000 in the game.
It's an exception to the rule, because what the developer needs is pre-sales, and the bank wants to have a look at those contracts of sale to see what pre-sales are in place and how much skin in the game the buyer has got. And if everyone's only got $1,000 holding deposit, then the reality is that there's not much skin in the game then, right? Now, so in this particular business, I don't know whether that's how they operate, where it's a minimum of $1,000, if that $1,000 is fully refundable. But what I'm saying is the evidence that has been presented to us, and the people who come to us for help on regular occasions, whether I'm putting my PIPA hat on, Property Investment Professionals Australia, or PICA, where people have been ripped off, or even in our own business, that's what they're coming to us and saying, I've signed this contract. Now, with the house and land packages, we had similar instances at the back of the peak in 2006, 2007, where people bought these house and land packages had rebates, right? And they did have subject to finance on them. So what was then happening was we were saying that the client was then arguing, I'm not going to proceed, But if you put the application in, the developers or the selling agent would say, well, show us where you've got the decline letter from the bank. And they're like, well, what do you mean? I said, well, if you put an application into the bank, it's going to get approved, isn't it? And they're going, yes.
Yeah, they're not going to let you go easily.
So they are not going to let you go easy. So how do you get out of it? How do you get a decline letter from the bank? So part of the work we were doing to fixing up a lot of mess was around sort of saying to a bank, and to the client, you need to get some legal advice here. But it would have been better that you got the legal advice or a tip not to go into those types of things in the first instance. So it's really, really, I just felt that was, the word, not the full truth. I got a sense that because in some cases there may be some marketeers and selling agents who are parading as property investment advisors, right? And they may have a deal with a particular developer who says, I will just take that $1,000. I've got enough pre-sales, and just knowing that there's, in the marketing collateral where I can say there's only 25% left. You see it on the boards, almost all sold and those types of things. So there might be instances, an example where that's true, but in a lot of cases, people are putting 5 or 10% deposits down, and that doesn't protect the client. If the bank valuation comes back, they will lose that deposit if they don't proceed. And as we saw, as you'll listen to when you listen to the podcast, because I highly recommend you listen to the entire podcast, some of these people, they've lost the opportunity cost. They're sitting on these properties. They haven't gone anywhere with those properties. Now, we are not perfect in terms of buying existing properties either. Full disclosure. Yeah. We've bought over 1,000 properties for our clients, and we can't sit here and say everyone's, shot the lights out. There is still a science, and it's not an exact science. But in terms of negative equity and what we've been buying and how we've been buying and the long-term view of those properties, so everyone's sort of saying this is self-interest because you don't do what these other marketeers do. True. We try to be, basically, fee-for-service independent in our property advisory work that we do. In fact, we're staunchly independent in terms of what we try and do there. Yeah. Because we've got the whole market to choose from.
We do. And so, Ben, I think I don't fluff my pillows too often, but I think I'm probably uniquely positioned in the country because I need to tell you the right ones to buy, but I can tell you the wrong ones from personal experience. So if people are thinking about the, how do I put my head on the pillow with those commissions back then, I have thought about that. A couple of things. One, I was playing in the 150, 170, 190. Probably the most expensive for me back then was probably 300,000. Yep. So those people, time's been okay for them. But the thing is, I personally invested in the same stuff, and when GFC come, everyone loves to pull out their favourite Warren Buffett quote: "When the tide goes out, you see who's been swimming naked." When the tide went out at GFC, Ben, I almost went belly up. Yeah. And so my wife and I faced a terrible time at GFC because we were holding the wrong stuff, had the wrong mindset around it, had the wrong vision around it, my value set around money and all those sorts of things were just flawed. So not only can I tell you what to do, I can tell you what not to do from personal experience. So my portfolio now, I'm proud of where those properties are now. But back then, I made all the mistakes. I know. I'm just trying to be raw and real today, Ben, because I don't want people to go through the experience that I went through. Yep. And maybe that's a bit of the karma bus, Ben. If you're part of enjoying the spoils early days and you got the wrong attitude, maybe that was the experience I had to have. But just to remind people of the spectrum, because we have said this before, but for the benefit of repetition as the mother is learning, there's two ends of the spectrum. There's one end that we feel that we're at, Ben, which is the pure advisor end, which we have zero conflict of interest. That we get paid zero from any of the properties that we buy.
Any other party.
There is no vendor payment to us whatsoever. And there are plenty of people in the marketplace that are like that. Yep. We've got some peers, some of them have been on our podcast, right? At the other end, you've got the person that's sitting in the sales booth of these developments, and their agenda is very clear. They are trying to provide a living for their family by saying, I'm a salesperson and I'm trying to sell this stock. And that is totally fine because their agenda is clear. It is the person in the middle of the spectrum who's actually on that side, which is selling stock, who's masquerading as being on that side, which is the conflict-free advisor. That is where the definition of the spruiker comes in.
And those operators are also looking for referral partners. And again, perfect examples of they need to find new people all the time.
It has to be new people.
It's usually because
the repeat businesses.
You know, I was surprised that, you know, the particular person who was interviewed, one of them, decided to do two. But that's the sort of thing. So this is what happens. You have high trust with your accountant. You have potentially trust with your mortgage broker. You have trust with your financial planner. And they are referring into these particular operators, probably naive, probably, you know, amateur, enthusiastic amateurs, having no real idea of the potential financial burden they are putting those clients under. I mean, if they knew, would they keep doing it? Now, if they keep doing it, it's purely based on self-interest. They are getting a referral commission, a kickback, in terms of what's being paid. And in some cases, it's disclosed. Like in some states, you do have to disclose those third-party commissions, but they've built up a level of trust. And so the client who's thinking, well, wait a minute, they've done a good job on my mortgage, they've done a good job with my tax, they've done a good job in advising me around my super, why shouldn't I trust them? Because they don't know what they're talking about. Or they're going at it from an angle of taxation benefits, right? And thinking that they're doing a great thing for their customer in terms of reducing a tax, you know. And so it doesn't matter what the return on the property is going to be.
The poor old accountant.
It does matter.
Because there's accountants who listen to us, Ben. The poor old accountant's got 2 volumes of Tax Act that they've got to be across, right? So unless they choose to be a specialist in property,
correct,
it's not fair to judge them to be the specialist in property because they've got so many other things that they're across. So it's not a witch hunt at accountants.
No.
It's just saying if you're getting referral advice, as you said, from a very trusted advisor, you've got to be careful.
If you are getting a referral, ask this direct question from that professional. Are you getting paid? Are you getting paid? If it's a professional introduction and there is absolutely no payment going between those two parties,
then they are an enthusiastic amateur.
Then good news for you, right? And then go there with, you know, your cautious but open mind and listen to what they have to say. Because again, 80% of what these seminars talk about, there's actually some good content in there, right? And it's enough to get you
That's the challenge. 90% of it's really great.
Yeah, and it's the
product fulfillment.
The execution, right? It's the product fulfillment that they're doing is the problems. Now we've been rabbiting on a bit here. We've got some questions here. Let's go to some of those questions, and then I'm going to share some of the top tips.
Yeah, I like it. So Brittany's written in and said, buy, beware. Hi guys, absolutely love your podcast. Wanted to share something I found on one of the portals. The offer is buy an off-the-plan apartment and get a free Mazda 2, Ben. That's a good deal. We get a house and a car.
Get a house and a car to buzz around town.
Reeks of a buyer beware scam. Is this even legal? I've never seen anything quite like it and had to share it with you guys. Thanks, Brittany. Well, Brittany, 2 things. 1, thanks for writing in. And 2, that is another way. So the answer is it is fine because you're not paying for it.
Yep.
But that just gives you an indication. If someone can afford to give you a car, how much are they actually getting on the deal?
Well, and I think that's the point, isn't it? Like if that's the developer going direct to the customer, and they might have their own internal sales agency. If they were using, say, a marketing company, an external marketing company, that's a $25,000 or $30,000 cut. That's the $25,000 or $30,000 commission that was going to go to a third party. So, you know, home loans come with free holidays.
Correct.
So that is marketing 101, and that's one of the classic ones. The other 2 classic ones that you've got to be very, very critical of, highly critical of, is incentives around rental guarantees.
Yes.
We heard that on the podcast as well.
No, but it's worth repeating, Ben.
It is, because people don't get it. It's loaded into the price you pay. Remember, that this is shiny and new. These properties look fantastic. The brochures look amazing. The future plan of the mega city that's going to go around the house and land area, and the new rail line, and the Westfield that's proposed in 45 years' time to arrive.
Proposed.
You know, it's proposed. Like
when that arrives, our great-great-grandchildren will enjoy that.
So rental guarantees, and then rebates or some type of incentive offer.
Can I amplify your point on rental guarantees?
Yeah.
There's not a single property that we have purchased. There's not a single property that any of our competitors that we have interviewed on this podcast we know personally, there's not a single property that they purchase, that we purchase, that a rental guarantee is involved.
No.
Not a single one of them.
Very good. So thank you for that question. That was a nice little one there. Brittany, thank you for shouting out those types of incentives.
So this one's from Alana. I've been listening to your podcast. I've invested in a house and land package in Tarneet. I'll be an owner-occupier. I'll be investing with a friend, therefore half the debt will be mine, and we will be investing around $450,000 in total. There are proposed schools next door and a shopping mall and a train station going in. Everything in your podcast leads to don't buy a house and land package. Have I stuffed this up already? Well, so there's as an investment versus as someone who wants to live in it. Now, there is a community of people, Ben, in that particular suburb who love being there, and they get joy and satisfaction out of being there, and it's a great community to be in. So as an owner-occupier, in the reference to your question of have you stuffed this up? No. But would we recommend someone invests in that particular area? Well, it comes back to
supply and demand.
Supply and demand.
Now,
Scarcity.
Scarcity is your friend, and if there's lots of development going on out there, there's going to be a period of time where you're going to have stagnation until the market eventually catches up. And then the next phase of buying, which might happen in the next 7 to 10 years, you will see some growth there because you're taking land. So part of me says congratulations for showing the initiative in terms of what you're doing there. And you've obviously got the infrastructure pieces that you're looking for, which is the train and the schools and those types of things. All good things. The other tip I would make for anyone who thinks they still want to go down this pathway of off the plan or house and land is buy significantly under the median. Protect yourself from downside risk, because if you can get a cheaper home built on good land, but basically negotiate as hard as you possibly can to get the best deal you possibly can, you're probably at less risk of having negative equity when the property's finally built and you occupy it.
And Alana, there's also other things at play here. Some people on incomes that don't allow them to buy anything other than sort of entry-level house and land packages in some of these land subdivision estates. So please make no mistake, and we may not have laboured this point enough, Ben, that we're not tarnishing those houses and we're not tarnishing the people that live in those areas, and they are definitely a step on the property ladder. What we are saying is when the marketing companies come in and then they give assertions about what the performance of those areas are from an investment perspective, that is where all of our advice is going towards this podcast, and making sure that you understand that as an investment, there are alternatives.
We've talked about it before, Bryce. Not every off-the-plan or house and land packages will be a dud. We do know people who have made money out of house and land packages. We've had reviews of people telling us that they've made money out of house and land packages. But the majority of the experiences that we see in terms of people making more money or the value of those properties underperforming is real. It is real. There is no doubt in our mind that the capital growth based on those properties over the short term is usually significantly lower than what we would get in better buying through better research in terms of it. So that's been our observation and the data that we've seen, and it also highlights the fact that you have increased experience of negative equity in the mass-produced type of stock.
It's fact. I've just had an analogy. I haven't been to Alcoholics Anonymous, Ben, so I just want to be respectful of anyone who is struggling in this area. But they've got a saying around, if you don't want to slip, don't go to slippery spots. So, and by that they're saying, okay, if you don't want to slip up, don't go to the pub, don't go where there's alcohol. But using that as an analogy, for some people who are going through that program, Ben, if they were to put themselves into a place where they would be exposed to that, they could quite easily be fine, right? But for the majority, it's a slippery spot. So I guess the analogy that I'm trying to create here is, for some people in the off-the-plan space, not everyone's going to slip, but for the majority, it's a slippery spot. And
they are some of those seminars are polished. It is a rags to riches story.
They are silver tongue.
They are getting people up on stage who have had success. You know, so they've got a percentage of people who have had success. I would question the majority of the people. You know, if they were to do an audit across their full portfolio of the properties that they've, how successful have they all been? So you know, that's where about being an informed buyer is really important. What have we got?
I've got one here from Juan. First of all, thanks for your great material. It's great, especially for someone like me who is new to Australia. Understanding the way everything works here is gold. We haven't said gold for a while, have we? Unpack. We haven't done unpack for a while.
The gold, Bros.
I've heard most of your podcasts and also done some research online, and I wanted to ask a question around off-the-plan investments that I still can't understand. One, great question, because if you can't understand it, I'm sure there's plenty of other people who feel the same way. Everywhere people say it's a big no-no. I understand the risks involved, delays, not seeing the finished product beforehand, etc. But my wife and I have found an off-the-plan property in a suburb we like, Bentley, within the McKinnon school zone. And we think it's a good place to live. The developer has done at least 3 different developments in the area, all of which we like the finishes and have built in perfect timing. I wanted to ask you why this would be considered a really poor investment. Off-the-plan properties, definitely a no. I understand the case of Docklands and closer to the city suburbs where we had thousands of developments which made the price go down, but in Bentley, I don't think this is the case. I subscribe to location score, and the score is relatively well considering that I live in this property and it's within my budget now. I just wanted to get a sense of your thoughts around this, as I am a true follower of your words of wisdom. Hopefully you have some words for me. Thanks in advance, and keep up the excellent work in empowering people like me with information. One. Ben.
I love that question, because this potentially opens up what we were just saying, that there can be some gems, there can be some opportunities in this space. The risk, however, is this. So first, I'll finish off with the risk in a minute. I want to start with, great, so go back to those last 2 developments that they've done and have a look at their performance. And it's pretty easy to be able to get onto realestate.com.au or domain and basically do valuations on properties. They have valuation tools on there now. It's going to give you a range. You should be able to see some of the historical sales. So there's lots of historical sales data out there you can get for free now. So you can then start doing that analysis for yourself. Now, what I want you to do is then compare that to an existing property that's been built 20 years ago, and compare the capital growth for that property compared to this one by doing a reversed capital growth calculation on an annualised basis. That is ultimately where you're going to see what the performance looks like. So Bentley, well held, very strong planning guidelines around that, but we are seeing more and more of these lifestyle type, downsizer type properties that are coming to the market, where the older people are moving out of their more period homes and looking for something convenient and also easy to live in. Yeah, and that is a real market, and that's got strong demand, and these people are cashed up. So it's not your traditional investor type market. The risk, however, is still in the fact that more and more of these things will be built, and there is potentially, they'll get to a critical mass where they'll get an oversupply for that type of thing. So right now, there could be scarcity.
Well, because in Bentley, a lot of old houses, 1 become 2.
Correct.
So there's still scarcity in that. And so the land will still do 80% of the heavy lifting. But you just got to know that because it's brand new and shiny, you're going to pay a premium price. And next year, it's probably worth a little less. But if you're bought in the right location, it'll do okay. But it's scarce. It's got owner-occupier appeal. But the developer has to make a margin, the builder has to make a margin, the marketer has to make a margin. Therefore, it has to be more expensive.
High quality, bigger footprints, not your Lego land type stuff, are the ones that usually do perform and give capital growth over the medium term. Because again, it comes back to reseller appeal, that demand for testing the market in terms of, I walk into a beautiful lifestyle apartment that is not the standard, 56 square metre, 2-bedder and everyone in the block. It's spacious, it's a little bit more open, the roof ceilings are a little bit high. It's got all of those things. So they're the types of ones that we will say will attract a future buyer. And that's where, and an emotional buyer, which will push up the value over time. So I think that is a great question.
If in doubt, say no. If you've got a little bit of experience, you might be able to interpret some of the things that we've been talking about. But if you don't want to slip, don't go to slippery spots. Good one. Got to sneak a quick one in, Ben.
Yeah, sure.
It's from Phoebe. Hi, Property Couch. I have a question for you. My partner and I have recently signed a contract for a 2-bedroom, 2-bathroom apartment in Camp Hill in Brisbane. It is a brand new apartment building. Small block, only 7 apartments. Well, that's a tick because it's 7, but let's keep going. We plan on living in the apartment for now, but would like to rent it in the future, roughly 3 to 5 years' time. The developer originally wanted $569K, dropped it down to $539K, and we signed a contract for $529K. When applying for a home loan with Suncorp valued the property $29,000 less than the purchase price. The report considered market direction, volatility and segment conditions to be of medium to high risk. This is very concerning for us as first home buyers. We don't know whether the banks are just being overly cautious. What are your thoughts on this? I know you mentioned in your very first podcast, if you're buying new, you are most likely paying too much. We think the apartment is really good quality and ticks a lot of boxes. Help. Thanks for your time, Phoebe. I probably just read that out just to probably just
reinforces
as
everything
bullet points for what we've just
right?
been talking about.
Yeah.
So, Phoebe,
If I was Phoebe, I'd be sort of saying, well, why don't I get a second independent valuation, right? And to get a sense of it, you've obviously negotiated really well. People like you who have negotiated well, but the first purchase price was $569, right? And it's come in $29,000 off the $529 that you paid for.
$569 is now valued at $500.
So good on you for firstly haggling and trying to get the best deal you possibly could. But it is true. I mean, Brisbane is a marketplace that is experiencing oversupply in the apartment level, even though it's 7. I think medium to longer term, you're going to be okay with that particular, because it's serving 2 masters here as well. You're living in it. So it's not a pure investment play. So there's obviously been some judgment around the area that you want to live in, and obviously the lifestyle drivers in that area, which are pretty good. I know that area reasonably well in Brisbane. So I wouldn't be panicking at that particular thing if it's a 3 to 5 year.
Well, it's one of 7, so there's ticks on this, but
it just highlights that people will overpay for new stock, and it means your capital growth story is starting from a back position.
It's like running a 400-metre race, starting 200 metres behind. So
Bryce, I just want to finish off with a couple of the quick tips. So I just want to round out, again, if you haven't listened to our podcast and you want a summary of what we've been saying over the journey, let's just go through some of the big things that are important if you're going to play in the offer plan or house and land packaging. So firstly, be highly critical of incentives. I mentioned that earlier. Be critical of selling tactics such as this opportunity won't last. They're pressure selling you. This is the last one I've got for sale in this complex or this estate. The values have already gone up $10,000. They normally can't validate those claims. Yesterday I sold two. They're going quickly. They are the pressure selling tactics that I want you to avoid and hear those cues. The other thing, never ever buy for tax benefits as your primary reason of purchase. If you are getting sold the benefits of the property based on depreciation and based on the tax benefits, i.e. the negative gearing rebate that you're going to get, that is not what you invest for. Okay, that helps you from a cash flow point of view, but it certainly isn't about the return on investment that you're ultimately going to get. Now, I'm also going to highlight 2 really important points when it comes to if you do decide to go down this. I mentioned it earlier. Number 1, scarcity is your friend. All right, the risk of current or future supply will kill any potential capital growth returns. You are looking for absolute unique opportunities, converted warehouses that can't be replicated easy, views that can't ever be built out before. If you have got an uninterrupted view of Sydney Harbour, Sydney Opera House, my God, have a look at the prices of those properties and they go up in value. So, look at the proven best developers, because don't just go with an unnamed developer if you don't know who they are. And this is critical in terms of whether you're on a good deal or not, because this will crash most sales, what I'm about to tell you. This is around what's going to be written into your contract of sale. And I'm going to put a little caveat here. Make sure a property lawyer is writing these clauses, all right? So what I'm telling you is not the way in which you write the clauses,
it's the general gist.
It's the general gist of what's going on. So number 1, you want to have a clause in the contract that says you can void this sales contract and get 100% of your deposit money back within 7 days of requesting it if the valuer working from the lender of your choice undervalues the property on the completion of the build. Mm-hmm. So in other words, if you have that experience like our good friend just had, in terms of...
Mate, you've just taken the colour out of the face of most people doing the sales.
Selling, no, they're not going to accept that. They're not going to accept that. Of course they're not. So that's a sign that it's not necessarily good product. Because if they had great product, it should sell itself, right? Yep. Number 2, the contract will be voided in the event of your decline from the financer lender of your choice. So in other words, if you go to a lender, because what's happening in today's market is pre-approvals are only valid for 90 days. Now, lots can happen. You know, we could potentially see APRA reintroducing some prudential regulation into the marketplace because property prices are moving too quickly and they're scared of that, right? So if we do see some of that tightening of borrowing power again, then all of a sudden all of these people who are buying, their servicing calculator may not justify that. So that is protecting you in the interests of things that are outside your control, which means that you can get out of the contract. Now, those two clauses will basically be declined by almost 99 out of 100 selling agents who are working to sell those types of properties. But that should tell you something in terms of what that looks like. So if they won't accept those two clauses, how confident are they in the product? Now, if they say, well, the market could move, and you know that's on everyone. Yep, and it could move. But if you want my business, in really at the moment, the buyer is in complete demand when it comes to house and land packages and off the plan. The power is in your hands. In the existing property space at the moment, it is not. Unfortunately, it's turning more towards a seller's market than what it has been. It's probably balanced to maybe leaning towards sellers, but in the off the plan and house and land package space, for at least the next couple of years, you are in total control. So do your research, do your due diligence, look at historical performances, look at properties around the area, go to the planning department, see what future plans are coming through, because you always carry greater risk when there's going to be more supply coming online.
Well said, Ben. Folks, we cannot labour the whole reason that this podcast exists is to protect you from the very things that we've been talking about in this particular episode. I've been through it myself personally on both sides of the fence. Just don't do it. Just really, as I said, don't be sceptical, but don't be naive, don't be ignorant. Make some good decisions. And if you are one of those folks who've joined the community of late, go back to episode 1 and 20. At the end of this very episode, I'm going to tell you exactly how you can download the binge guide. Go and study it. They are the fundamentals. And I make the mistake that everyone in our community knows that stuff, Ben. But I'm quickly learning that not everyone does. So they are the fundamentals. Hey, my life hack today, Ben, is...
What do we got?
Do you know... Actually, I do know this, but it's scary.
Did you know? Okay, you're doing my did you know, do you?
Oh. No, I don't want to steal your did you know.
All right,
I didn't even realise that I'd stolen your did you know. But Google keeps a ridiculous amount of data about everything you do online. Right? So I knew that. But then, so this is my life hack. Go to myactivity.google.com. Have you ever done that?
No, it's thousands of pages, isn't it? Tens of thousands of pages.
You can review the data, you can delete any or all of it, and you can see how they track and save your data. So I went and had a look, right?
Oh, yeah.
So imagine the browser history on your Chrome or your Safari or whatever you use, right? And you go and you see, you think, oh, yeah, mate, this is next level, Ben. Every YouTube channel I've visited, every map that I've used on Google, it is phenomenal what they have on you.
So what's that URL?
myactivity.google.com.
Okay.
Go and check it out.
Go and check it out.
But,
very good.
But you'll never view Google the same again if you once you see how much. Like I knew they had a fair bit, but far out.
Oh, I mean, if it's used for the power of good, which is to make your life easier.
Well, it is for the power of their good, mate.
But it can sometimes be converted. I'm still a big believer in the future. So I don't mind that they've got that data if where I'm going is where I'm going. And they can help me get there quicker. In terms of
when the robots take over, mate, you can come back down to my place down the beach where the robots won't be. So,
very good. When the robots take over, they'll drive me.
Drive you down. Did you know?
Did you know? I thought I'd reach out to our good friends at SQM Research and get some of their latest data on stock on market price.
Okay.
Because obviously it's been well documented that stock has been down, and that's why it's been obviously the pent up demand for buyers is out there. But I just wanted to let you know that the listings increases in October by 2%. So listings went from 312,754 in September 2019 up to 318,874. So that's the number of properties that are currently available. Now, compared to the last 12 months ago, listings are still down 4.8%. So it has been an improvement, but they're still down. So I'll just do a quick round the grounds. Sydney, in terms of their monthly change, their stock levels increased by 4.2%. So they're now sitting at 29,000 odd properties. Now the change for the 12 months is -19. So they've got stock supplies in terms of existing stock up there big time.
Tell me Melbourne's gone up, Ben.
Melbourne has gone up as well,
No,
3.7%.
year on year, come on.
Oh, year on, definitely not. So it's down 7.8%. The only market that has gone up year on year, Bryce, has been Canberra,
which
is up 2.4%.
And
Hobart,
don't worry about the last one you can't see.
Which is
the only one that's gone up. That's now
sorry,
only two.
Only two that I've just looked at there. Oh, there's Adelaide's gone up a point.
But besides that, none of the others have gone up.
I was looking at the monthly changes.
Yeah.
All of them gone up over the month except for Darwin, which is down 2.4%. So, but isn't it interesting? Like Darwin's stock on market is 1,921. So again, we keep looking at all these capital cities, but there's I think on last count there's 13 cities that are bigger than Darwin that aren't capitals, right? So it's obviously a nice summary, but it just highlights that there are different markets that you can look at around the country to buy. So not a bad news story that we're seeing more property come onto the market as the market's improving, and we'll keep an eye on that over the course of the next 6 to 12 months, check in on basically those stock levels to see what's happening, because we do need more stock, because we want to try and have a steady marketplace. We don't want to have a booming property market.
Come on, vendors,
again.
list your property, otherwise APRA's coming. APRA's coming back.
Very good. There it is.
Very good. Did not know that, Ben. But mate, thanks for your input today. I think it's a very important message. I think it's hopefully one that we don't get people writing in anymore.
So and check out the Money podcast. It's in the show notes.
We'll put it in the show notes. We'll put the link to my life hack in the show notes. We'll put everything in the show notes. Iris is brilliant. She does all that for us. But until next week.
Knowledge is empowering, Bryce, but only if you act on it.
See you next week, folks.
Hey there folks, Bryce Holdaway here. Before you go, if you're new to our community and only listen to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarises the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.